Chapter 5, The Complete Cycle. Take a joyous ride on the accounting cycle. This chapter presents the complete cycle of accounting that involves all the following activities of financial record keeping. By understanding the following table, you will get to know accounting as a business function with respect to what is involved as a workflow. Activity. Description. Journal entry. The activity of recording every financial transaction, evidenced by a suitable voucher, as per the rules of debit and credit is known as a journal entry, or JE. Ledger posting. A ledger is a T-form table of representing the debits, on the left side, and the credits, on the right side, for each account to show how that account is impacted by other accounts across a given reporting period. Posting the ledger is an activity of transferring all the JE pertaining to a reporting period into each account's ledger. This posting is done to take care of the dual aspect in such a way that if account XYZ appears on the credit side of the account ABC's ledger, then account ABC will appear on the debit side of account XYZ's ledger with the same amount. In the case of real and personal accounts which exist across reporting periods, they will have an opening balance either on the debit or credit side, which will be the first entry on the respective side. The closing balance will be the balancing figure, and could come on the debit or credit side irrespective of which side the opening balance was, depending on the total of debits and credits this account received during the reporting period. Trial balance. The trial balance is nothing but a schedule of all the accounts in the books along with their closing balances as of the end of the reporting period, tabulated either under the debit or credit columns. A different variation of the presentation, not used in this book, is as a summary of opening balance, debit or credit. Sum of periods debits. Sum of periods credits. Closing balance, debit or credit. Just like the balance sheet, the trial balance must always tally for the totals across all the amount columns with respect to debit and credit. In other words, the totals of debit and credit should tally within opening balance and closing balance. Further, the total of the period's sum of debits and sum of credits columns should also tally between them. If that is not the case, then it is clearly a case of wrong posting from journal to ledger. Page 23 of 64. Finalization of accounts. This is done at the end of every reporting period and involves the preparation of the profit and loss statement and the balance sheet, using the period-ending trial balance as the basis. As explained in the earlier chapters, only real and personal accounts will be relevant across reporting periods, and nominal accounts will only be relevant for a given reporting period. So nominal accounts will get reinitialized to zero closing balance at the end of every reporting period, so that their opening balance in any trial balance will be zero. So just before finalization of accounts, in a trial balance, real and personal accounts may or may not have an opening balance, depending on if they were created/had postings in past reporting periods, and will have a closing balance as altered by the sum of debits and sum of credits against their account. Nominal accounts will have zero opening balance, and their closing balance will be a direct result of sum of debits versus sum of credits against their account. Now, as part of finalization of accounts, all the nominal accounts will be closed by transferring their balances to P&L account, which is a personal account, as explained in earlier chapters. Every nominal account of type expense will be closed by the following journal entry. Account name. Rule. Amount. P&L account. Debit TB closing balance. Expense account. Credit TB closing balance. Total TB closing balance. Every nominal account of type income will be closed by the following journal entry. Account name. Rule. Amount. Income account. Debit TB closing balance. P&L account. Credit TB closing balance. Total TB closing balance. This will give the P&L account either a debit balance, if there is a loss, or a credit balance, if there is a profit. Now the revised trial balance will only have a balance for real or personal accounts, including the P&L account, and then the balance sheet is simply a question of plotting the real and personal accounts on the assets and liability side. Page 24 of 64. The journal. The journal is the starting point for recording a financial transaction and captures the financial components of a transaction as per the rules of debit and credit. Let us say vendor ABC Enterprises was paid a sum of $40,000 in part settlement of the amount due to them. The journal entry for the same will be as follows: account name, account type, account category, rule, amount, ABC Enterprises, personal liability, debit $40,000, cash, real asset, credit $40,000, total $40,000. Accounting rule narration. ABC Enterprises is a personal account, and hence we debit the receiver. Cash is a real account and we credit what flows out. A piece of machinery is getting sold for a consideration of $50,000, while the value of the asset in its ledger is $65,000. If we analyze the economics of this transaction, the ABC Enterprises realizes $50,000 in cash for a machinery valued at $65,000. This means that it is incurring a loss of $15,000. Journal entry for the same will be as follows: account name, account type, account category, rule, amount, cash, real asset, debit $50,000. Loss on sale of machinery. Nominal expense. Debit $15,000. Plant and machinery. Real asset. Credit $65,000. Total $65,000. Accounting rule narration. Cash is a real account and hence we debit what flows in. Loss on sale of machinery is nominal account and hence we debit expenses and losses. Machinery is a real account and we credit what flows out. The ledger. Simply put, a ledger represents an account summary of all the journal entries in which it participated in that reporting period, is typically represented in a T form table with both the debit and credit aspects forming the two sides of the T. The accepted convention is to represent the debit aspect on the left side of the T and represent the credit aspect on the right side of the T. Page 25 of 64. A ledger view of an account is complete only based on the period for which it is viewed. Based on a given reporting period, a ledger view of an account will present the following information about it. Opening balance since inception to the starting date of the reporting period, also known as balance brought forward. If the sum of historical debits are more than historical credits, this will be listed on the debit side. If the sum of historical credits are more than historical debits, this will be listed on the credit side. The list of accounts by which this account has received a debit along with the amount. The list of accounts by which this account has received a credit along with the amount. Closing balance as at the end of the current reporting period, also known as balance carried forward. If the debit side is more than credit side, this will appear on the credit side as a balancing figure, but will be known as a debit balance. If the credit side is more than debit side, this will appear on the debit side as a balancing figure but will be known as a credit balance. Now let us look at the impact of the journal entries discussed in the previous section on the ledgers. For the purpose of this exercise, the following opening trial balance, also known as balance brought forward, are assumed from the previous reporting period. Account name, account type, account category, balance type, amount, cash, real asset, debit $46,000, plant and machinery, real asset, debit $165,000, ABC Enterprises, personal liability, credit $165,000, equity capital, personal liability, credit $46,000. Total $211,000. Let us now look at the ledger views for a given reporting period. Account, plant and machinery, real asset, debit account, amount, credit account, Amount. By balance brought forward. 165,000 to cash. 50,000 to loss on sale of machinery. 15,000 to balance carried forward. 100,000, total of debits 165,000. Total of credits 165,000. Page 26 of 64. Account. ABC Enterprises. Personal liability. Debit account. Amount. Credit account. Amount. To balance brought forward. 165,000 by cash. 40,000 by balance carried forward. 125,000, total of debits 165,000. Total of credits 165,000. Account. Cash. Real asset. Debit account. Amount. Credit account. Amount. By balance brought forward. 46,000 to ABC Enterprises. 40,000 by plant and machinery. 50,000 to balance carried forward. 56,000, total of debits 96,000. Total of credits 96,000. Account. Loss on sale of machinery. Nominal expense. Debit account. Amount. Credit account. Amount. By balance brought forward. 0, by plant and machinery 15,000. To balance carried forward. 15,000, total of debits 15,000. Total of credits 15,000. Let us dwell on the following points to internalize some key points. The opening balance or balance brought forward is recorded on the same side of the ledger that represents its type of balance. The closing balance or balance carried forward is a balancing figure, and hence will appear on the opposite side of the nature of its balance. A closing balance appearing on the debit side of the ledger view is a credit balance. A closing balance appearing on the credit side of the ledger view is a debit balance. The debit side of the ledger view of an account should be understood as follows. The current ledger account is provided a welfare, or shown gratitude by another account in the ledger. Hence accounts on the debit side are prefixed with the keyword by. The credit side of the ledger view of an account should be understood as follows. The current ledger account is providing a welfare, or showing gratitude to another account in the ledger. Hence accounts on the credit side are prefixed with the keyword to. Page 27 of 64. Let us understand this with illustrations of the ledger postings above. If we take the plant and machinery account. For the cash part of the sale transaction, the plant and machinery account is providing a welfare to the cash account. For the loss part of the sale transaction, it is showing gratitude to the loss on sale of machinery account for absorbing it in its head and helping in reducing its closing balance by its full value of the sold plant and machinery. If we take the cash account. For the cash part of the sale transaction, it is provided a welfare by the plant and machinery account. On the payment side, it is providing a welfare to the ABC Enterprises account. The dual aspect of financial accounting in the ledger manifests in such a way that the same JE will be evidenced in all the participating accounts. The sale of plant and machinery for 50,000 is manifested as to cash in the plant and machinery accounts credit side, and as by plant and machinery in the cash accounts debit side. Instead of viewing this as a double counting of the JE, I want you to understand this as the dual aspect being honored by the activity called posting a JE to the constituent ledgers. The trial balance. The trial balance is a simple tabulation of the period ending balance carried forward of all the accounts from its respective ledger. A trial balance must match with respect to debit and credit totals, and is a proof of incomplete posting of journal entries to the ledger in case it does not match. However, a matching trial balance is not a proof of completely correct posting of journal entries to the ledger as well. A trial balance can also match as a result of errors on both debit and credit aspects of recording one or more transactions that may have netted off with each other. While in the modern days there is no concept of manual record keeping, and software automation will at least ensure that there are no errors due to posting of a journal entry to its constituent ledgers, this is still a valid assertion in the context of learning the subject, since you as a learner should know the manual aspects to be even able to write a software automation for it. The modified trial balance of our example after the reporting period JEs were posted to its constituent ledgers would be as follows. Account name, account type, account category, balance type, amount, cash, real asset, debit 56,000, plant and machinery, real asset, debit 100,000, ABC Enterprises, personal liability, credit 125,000. Loss on sale of machinery. Nominal loss. Debit 15,000. Equity capital. Personal liability. Credit 46,000. Total of debit as well as credit. 171,000. Page 28 of 64. Earlier on in the flow of learning across chapters, it was mentioned that nominal accounts like loss on sale of machinery account will neither have a balance brought forward or carried forward, and would be closed to a common account called P&L account. However, the nominal accounts will be closed to the P&L account of the current reporting period only as part of the finalization of accounts for the given reporting period, which happens only after the trial balance is prepared for a reporting period. The trial balance will therefore show balances for nominal accounts too, as it is more of a preliminary check to ensure that the ledger postings are completely done on both the debit and credit aspects of all the accounts involved in all the journal entries of the reporting period. Finalization of accounts. As part of finalization of accounts, two major categories of ledger postings are made. Adjustment postings are performed for transactions that need to be recognized for a reporting period, but which occur post the preparation of trial balance for a reporting period. This situation arises mainly in the olden days of manual bookkeeping, and is not relevant for the software era, but as a student of the subject it is still important for you to know this process. Since the trial balance preparation and reconciliation itself is a time-consuming activity, and is started well within the closure of a reporting period in order to ensure final accounts are compiled in time. Once adjustment postings are made, final closure postings are performed to close all the nominal accounts into the profit and loss account for the current reporting period. We will assume a very simple business scenario of the trial balance shown in the previous section, enhanced by a few more nominal accounts that represent the business performance of the reporting period. Account name, account type, account category, balance type, amount, cash, real asset, debit 80,000, plant and machinery, real asset, debit 100,000, ABC Enterprises, personal liability, credit 125,000, sales, nominal income/revenue, credit 53,000, trade discounts given, nominal expense, debit 3,000, purchases, nominal expense, debit 25,000, Def Enterprises, personal asset, debit 16,000, XYZ Enterprises, personal liability, credit 15,000, loss on sale of machinery, nominal loss, debit 15,000, P&L reserves, personal liability, credit 36,000, equity capital, personal liability, credit 10,000, total of debit as well as credit, 239,000. Page 29 of 64. The following additional transactions will help you follow the changes to the above trial balance. The equity capital of the trial balance in the previous section actually comprises of only 10,000 of capital infusion and 36,000 of accumulated profits. Gross sales for the period was 53,000 with trade discounts to the extent of 3,000. Out of the 50,000 of net sales, 34,000 was realized as cash sales and 16,000 as credit sales to DEF Enterprises. Purchases totaled 25,000 which were bought on credit from XYZ Enterprises. 10,000 was paid to XYZ Enterprises before the end of the reporting period. Closure postings to record adjustments and transfer the nominal accounts to the current reporting period's P&L account will be as follows. The JE for adjustment transactions is being deliberately left as a self-learning exercise for the reader. Account. Sales. Nominal income. Debit account. Amount. Credit account. Amount. To cash. 34,000. To DEF Enterprises. 16,000. To trade discounts given. 3,000. By P&L, 53,000. Total of debits 53,000. Total of credits 53,000. Account. Trade discounts given. Nominal expense. Debit account. Amount. Credit account. Amount. By sales. 3,000 to P&L, 3,000. Total of debits 3,000. Total of credits 3,000. Account. Purchases. Nominal expense. Debit account. Amount. Credit account. Amount. By XYX Enterprises. 25,000 to P&L, 25,000. Total of debits 25,000. Total of credits 25,000. Page 30 of 64. Account. Loss on sale of machinery. Nominal expense. Debit account. Amount. Credit account. Amount. By plant and machinery. 15,000 to P&L account. 15,000. Total of debits 15,000. Total of credits 15,000. Preparation of the P&L account. The preparation of the P&L account is nothing but recording the dual aspect of closure of all the nominal accounts, so that the net balance of all the nominal accounts can be taken forward to the balance sheet as either profit/loss for the current reporting period. The balance sheet can comprise of only real and personal accounts. The justification for the same is that the balance sheet is a position statement as on the end of a reporting period, and is not for a reporting period. Since nominal accounts relate only to a reporting period, they should not find an expression in the balance sheet. Hence a personal account called the P&L account accepts the closing balances of all the nominal accounts for that reporting period. The P&L account is a personal account, because it carries forward the net returns of a reporting period arising after settling the claims of all the stakeholders other than that of capital, and the net value is either profits owed, to be understood as an obligation, and hence a liability, by the business entity back to the capital stakeholders, who for accounting purposes are entities divorced from the entity of the business irrespective of the ownership type being company, partnership, or sole proprietorship. Losses, to be understood as claims and hence an asset, to be compensated by the stakeholders of capital to the business entity, since they are logically responsible for the conduct of the business whatever be the form of organization, as even in the most divorced context of a corporate entity it is only the shareholders who elect the managing board of directors. It is also an accepted practice to treat the current period's P&L account as a nominal account and transfer the net value to an account called P&L reserves which reflects the cumulative profit/loss of the business entity since its inception. In this case the P&L reserve account is to be understood as the personal account, that absorbs the net value of nominal accounts of a reporting period. We will complete the illustration assuming the above case since that is what reflects reality. Page 31 of 64. Account. P&L, nominal income or expense. Debit account. Amount. Credit account. Amount. By purchases. 25,000 to sales. 53,000 by trade discounts given. 3,000 by loss on sale of machinery. 15,000 by P&L reserves. 10,000, total of debits 53,000. Total of credits 53,000. Account. P&L reserve. Personal liability or asset. Debit account. Amount. Credit account. Amount. To balance brought forward. 36,000, to P&L, 10,000. By balance carried forward. 46,000, total of debits 46,000. Total of credits 46,000. Preparation of the balance sheet. The preparation of the balance sheet is simply a process of recording the balance carried forward in each real and personal account, including that of the P&L reserve account, onto the liabilities and assets side of the balance sheet. The trial balance would look like this after the nominal accounts are closed off as illustrated above. Account name. Account type. Account category. Balance type. Amount. Cash. Real asset. Debit 80,000. Plant and machinery. Real asset. Debit 100,000. ABC Enterprises. Personal liability. Credit 125,000. Def Enterprises. Personal asset. Debit 16,000. XYZ Enterprises. Personal liability. Credit 15,000. P&L reserves. Personal liability. Credit 46,000. Equity capital. Personal liability. Credit 10,000. Total of debit as well as credit 196,000. The simple rule to follow is, accounts with debit balance will be recorded on the assets side. Accounts with credit balance will be recorded on the liabilities side. Page 32 of 64. From an account type perspective, it can also be understood as follows. Real accounts are always recorded on the asset side. Real accounts do not have a theoretical possibility of having a credit balance, and hence will always appear on the assets side of the balance sheet. This can happen only if an asset is sold for a value more than its current balance in the ledger. In such a case it implies closure of that account itself, and hence the extra balance on the credit side is transferred to a nominal account called profit on sale of asset account, which in turn gets closed to the P&L account as part of finalization of accounts. Personal accounts are probably the largest type of accounts, as it represents interest of logical and physical entities, and hence represent a wide range of scenarios like debtor, creditor, P&L reserve, etc. Hence the following conclusions hold good about personal accounts and their relationship to the balance sheet. Personal accounts having a debit balance at the end of a reporting period are recorded on the assets side of the balance sheet as they represent claims by the business entity on those entities. Personal accounts having a credit balance at the end of a reporting period are recorded on the liabilities side of the balance sheet as they represent claims of other entities on the business entity. Balance sheet as of end of reporting period. Liabilities. Amount. Assets. Amount. Equity capital. 10,000, plant and machinery. 100,000, P&L reserves. 46,000, cash. 80,000, ABC Enterprises. 125,000, Def Enterprises. 16,000, XYZ Enterprises. 15,000, total liabilities 196,000. Total assets 196,000. Concluding remarks. This chapter used a very simple business scenario, since the main objective was to drive home the focal points behind each activity of journal, ledger, trial balance culminating in the process of finalization of accounts. The simplicity of the example was to ensure learning is given the highest focus. A more comprehensive business scenario is provided as part of the annexure, but has only a business scenario definition followed by solution. All the accounting explanation are handled as part of the narration provided to the journal entries, and there are some very strong concepts that are reinforced in those explanations which are possible only while providing a real-life business scenario. The reader is requested to use it as a self-learning technique, and match it with various concepts explained in Chapter 1 through Chapter 5 and treat it as an immersive learning experience. Page